Hey everybody, Matt LaPlante here with this quarter's update. All right, we're going to jump right into it. We are going to cover in this video two things. Really, very shortly, we're going to go over what we've seen thus far in 2021. More importantly, we're going to cover what I think is what we're going to see for the rest of 2022, and what's going to cause that. So let's start with what we've seen in the first quarter. So far, what we've really seen is a lot of pessimism, a lot of doubt and fear that has caused the market to sell off. Really not anything above normal, what we normally see in a given year. But a lot of it has been driven, it has happened much more quickly than normal, but a lot of it has been driven by the fears of inflation. If you've been watching my other videos or you've been watching any of my weekly videos I put on Facebook or LinkedIn, you've probably heard this many times, but inflation continues to be high. It's higher than it's been in quite some time. And so that is leading to a lot of the fear and doubt that we're seeing in the stock market. So I think it's a good time though, right now to go over the train, to look at the train station, dust that guy off, remind everybody what that is a little bit, but more importantly, how it can explain where I think things are going in the future. And it'll also explain kind of why we've seen what we've seen thus far this year. So let's jump into the train station. So here's the train station again, with a few little adjustments that I typically don't put in there. So let's start with everything on the left side of the line: traditional investments, stocks, bonds, and cash. You've heard about that many times. Everything on the right side, these all are alternative investments or hard assets. Just think of these as anything that you purchase. This is what goes into making them. So the oil in your gas tank or the wheat in your cereal kind of thing. Plus you have then real estate, which is wherever you're living, wherever you're working, whatever building you're in, or if you're renting a place on vacation or whatever. That's the real estate that's out there. All of those things on the right again are things that you can ultimately see, feel, and touch. That go into making what we purchase. Now the part that is different is down here on the bottom left here, the Federal Reserve. I typically don't have this in the diagram unless I do it live with you. I'll draw it in. But so we got the green and the red. Green line, that's really money getting pushed into the economy or into the train station. And the way that we see that is anytime you hear interest rates are going down, that means they're pushing money into the economy. And we've heard about interest rates going down really since the 80s. Interest rates have just gone down, till really within the past few months, they were at about zero, and then they started to come up, which is what they're doing now. So they're raising interest rates, pulling money out of the economy. So raising, pulling it out. That's the red line. So money's coming out of our economy, out of this train station. So there's less money to flow around to those, to all the different destinations because of, like I said, the money coming out. So what's going on right now? People are selling stocks and they're selling bonds. Now, why would they be doing that? If inflation is at 8% and you work at your job and your job pays you so much, maybe you got a little bit of a raise, but my guess is that whatever you're paying for your groceries and things like that, or the gas at the pump, that is gone up more than what you've made and whatever raise you got over the past year. So how do you maintain your lifestyle? Well, let's look around. We've made some good money in stocks. We've made some good money in bonds over the past several years. Let's pull a little bit from that, and that is how we're going to be able to take care of our lifestyle. That's one. Two, there are fears of a recession that, things are slowing down. The economy is starting to slow. Are we going to go into a recession? So as a result, the money is starting to go to cash. Again, so that people can pay for their lifestyle, but also for investors, they're selling and going to cash really is just an intermediary place before they invest it somewhere else. They're just sitting on it right there. But these next two areas are where a lot of people are going that are looking at the economy, and is very typical anytime we see inflation and or a recession. So inflation is the cost, the increasing cost of whatever we're purchasing. Well, these things on the right here, these commodities, demand, and futures, if the cost of what we're purchasing is going up, the things that make what we're purchasing are probably going up as well. So people are moving money into those areas. So they're buying things like oil, they're buying things like gold and things like that. Really things that anything that goes in that may protect them from inflation or potentially make an outsized return in those areas. And again, this is something that typically happens anytime you see inflation or there's a concern that the economy may be struggling. Very common, very typical. So the problem that we're seeing is that the Federal Reserve is pulling money out of the economy. So you can see that here. The money is leaving the cash bucket and coming into the Federal Reserve. Now that isn't, we haven't seen a lot of that really in the past, let's call it 10, 20 years. We've seen a little bit, but not a lot. Typically, the money has been going just in one direction. So the money's coming out. There's less money flowing around these different areas. To discuss and they're doing that really to try and slow down inflation and bring it down. Now, the unfortunate reality is that in general, when the Federal Reserve does this, when they're pulling money out of the economy, typically it ends up sparking a recession. They end up pulling too much money out. There's not enough money flowing through these areas. The economy slows down too much and starts actually, instead of growing, it's now shrinking because there's less money flowing through. So I personally believe that's where we're at right now. Unfortunately, we're in a position, or the way that we know that we're in a recession doesn't happen until months later, because you're looking at old data. You're looking in the rear view mirror at, oh, we were actually in a recession based on the data once it hits the headline. Again, I think we're in that recession, but now the most important thing is, now that we know that this is a situation, what is it that we need to do? How should we be looking at our investments, and how should we be preparing going forward? All right, so with the backdrop of the train station that we just went over, let's talk about what we should be focusing on. So one, if I didn't explicitly state it before, both sides of the train station are important to have right now. We can't just focus on those stocks, bonds, and cash. We got to have some stuff on the right, because that in general, that's what does well anytime you get rising inflation or high inflation. Also, if I'm correct and we're in a recession, that's the side that tends to do well in a recession, right? Money starts fleeing that left side and moving more, some to the right. So we need to keep an eye on that. That's an area we need to focus on. Two, this is talking about the left side of the train station. If we're talking about any kind of company, focus on quality companies, companies that have a strong balance sheet. So if a company that makes some kind of product or service that we really just can't do without. Because if inflation is going up, when there's less money to go around, companies that are luxuries, we're going to cut them out and may not spend as much money there. But a company that you go to get your groceries from or something like that, that company is probably going to be okay, and generally speaking. So let's focus on those kind of companies, but also companies that have solid revenue and very little debt. We don't want companies that have a lot of debt right now, because if you have a lot of debt, that means you don't have a lot of cash flow. Could be tight for you. Again, they're pulling money out of the economy. Federal Reserve's pulling money out of the economy, less money to go around, a little bit harder to get funds to build those future companies. So that's the last one. We need to be careful of companies that have dreams of the future, right? So if they're making something that might be really great in the future, it still very well could be. It's just that when right now inflation's up, or people are concerned about keeping their jobs or whatever, we need to be focused on those kind of companies may struggle for a period. Doesn't mean, like I said, that they won't be successful and create the next greatest thing. It's just right now they're probably not a good place to be focused on. So let's keep that in mind. As I mentioned, I think we're in a recession. That doesn't mean the end of the world. It just means that things are slowing down, and it just means you gotta take advantage of the entirety of the train station. You just gotta move where the money's at. So thanks, I'll see you guys next time.